This podcast is for professional investors only.
Things like deregulation, things like tax cuts, these will come. They will have to pay the piper later on, but as of today, these are upside surprises that could come into the US economy and therefore into earnings.
Welcome to a new episode of the Robeco podcast.
Appearances can be deceptive. Well, that seems to be the message reflected in Robeco's latest one-year outlook, which argues that despite various indicators pointing to a cyclical slowdown in the US, that economy remains remarkably resilient. Well, that's a challenging environment in which to be making asset allocation decisions, made even more complex by the evolving US political landscape. My guests to discuss this are Colin Graham and Peter van der Welle, two key contributors to this publication. Colin is head of Robeco's Sustainable Multi-Assets team, and Peter is a strategist in the same team. Welcome. Good to hear from you.
Thanks, Erica.
Thanks.
So you've titled your one-year outlook, "This is No Landing." So, Peter, I'll direct this to you because I suspect all the creativity around the thought and the philosophical aspects are attributed to you. Are you suggesting there's a risk that investors might misjudge the signals they're seeing in the markets and economies?
Well, in fact, they already have misjudged the signals that have been incoming into 2024. And so the title, "This is Not a Landing," is a reference to the famous surrealist painter René Magritte's painting, "This is Not a Pipe," and making a clear distinction between the actual object and its mere representation in the painting. And likewise, in the economy, we also have seen false flags raised about a possible hard landing in the US economy. The inverted yield curve, the fact that the leading ISM manufacturing indicator has already been signaling contraction for 24 months in a row, but that US hard landing didn't materialize, also not in 2024. So looking ahead, I think we could see a continuation of the gyration of market narratives, because now and then you will indeed still see indicators that flag immediate recession risk.
Yes.
And that's a treacherous environment in that sense.
Yeah. What unusual times we live in, because when we had this very same podcast a year ago on your outlook, that was also a major theme, what a surprise the strength of the economy had been in 2023.
Yeah, absolutely, Erica. And I'll just add to Peter's point about the old faithful of the yield curve, which basically says that we should be in recession now. But that signal has also not worked for investors over the last 18 months. So, yes, it's been a challenging environment. Start of the year, most people were negative in terms of the outlook for economies and therefore the markets. But actually, the outturn's been pretty good. And we've seen earnings actually surprise on the upside most recently. Still lower than expectations at the beginning of the year, but not a negative year. So that's really supported the equity valuations and allowed investors to chase risk in their portfolios and be rewarded for it.
So looking back at the beginning of 2024, we all knew it was going to be a landmark year because of all the elections taking place globally. And then, of course, the US presidential race, we knew that was going to be pivotal. So that was a key consideration. At the same time, I think there was a lot of hope and anticipation that emerging market discount would finally unfurl. How did actual events in 2024 match up against these expectations?
Well, I think this really comes down, let's take the emerging markets to start with. I think this really stems from the lack of stimulus coming from China and the authorities there. So investors thought that, okay, China should be stimulating because they have this property debt burden they need to stimulate the economy in order to work off. However, that didn't happen. But other things that were unexpected were things like the strength of the US dollar. So we're now at 55-year highs on a real effective exchange rate basis. The only time it's ever been higher was actually the end of 2022. So
is that because US rates remained higher for longer? The key
that was the key, but also the US exceptionalism. Where could you get access to companies that are on the cutting edge of technology? The US. So from that perspective, but there have been companies within emerging markets, some of the chip companies who have done very well out of this as well. But the concentration of them is more in the US.
Right. And that was an important theme, again, throughout the year, the narrowness of the market gains on the equity side anyway. US large cap tech, Peter?
Yes, indeed. But by the way, to come back to the EM point, also within EM, you have seen quite a bifurcation as well.
Yes.
Also, when you look at, for instance, the dispersion in equity valuations. So the discount is still there for the reasons that Colin highlighted. But also there you have quite lopsided valuations. So India is even more expensive compared to the US. And that's a very interesting phenomenon to see.
And also a few disappointments aside from China on the EM side. The Korea value up policy somehow hasn't delivered to the extent or as soon as investors had thought.
Yeah, I think this is one of the reasons that we were long emerging markets at the beginning of the year. And once we saw the China stimulus and we saw the jump in Chinese equities and emerging market outperformance, we basically took it back to neutral because we still see it very difficult that the catalysts are not there for EM outperformance right now.
And on the DM side, you've spoken about the US. What about Europe? Has that been a disappointment too?
Economically speaking, it has. So Germany remaining in its recession. The periphery holding up well thanks to tourism revenues. But overall, also politically, a very difficult climate. But I think looking ahead, there might be a few bright spots on the horizon. And maybe ultimately even the stars are fully aligning for Europe. So I'm quite upbeat about Eurozone consumption growth. A bit above consensus, 1.5% 2025 real GDP growth is expected in our outlook. Because really European consumers have underspent. So savings rates are historically elevated. Real disposable income growth is also really benign. Right. So there's room for catch-up.
Right.
A lot of that bad news is already in the price. So if there's any pullback on the expected tariffs, then that'll be positive for Europe.
Yes.
Europe could be in a good negotiation point here because they need to buy more energy and more defense. And those are two sectors that the US has in spades.
Yes.
So from that perspective, then you've seen how tariffs work. The US, in particular Donald Trump, uses them to negotiate. And we go back to 2017 with the negotiations with China, and you saw that because China bought a lot more farm products from the US, the tariffs weren't as high as they initially thought. So if the Eurozone and the rest of Europe play their cards right, it could actually turn out to be a positive rather than the negative that is priced in today.
Yeah. And everyone understands the rules of these games, right? Europe is already positioning to play those cards correctly.
Who knows what happens in politics? You've seen the election in Germany coming up now, which nobody had expected. So Macron's base has been undermined. So so the two big powerhouses in Europe, can they put a united front together to tackle this? It's going to be difficult to see.
You finalized this report at the end of 2025 while the last of the US votes was still being tallied. So I would imagine it's quite an interesting and perhaps a difficult vantage point from which to assess how markets are going to behave in the coming 12 months. So on that point, how critical is US policy for this outlook for 2025? Peter?
It is of pivotal importance, but I also want to say that the legacy of the Biden administration is important as well. So there could be still some carryover of the Biden administration into 2025 US growth numbers. So we did an analysis, and whenever the incumbent party loses the presidency, typically US growth in a subsequent year is around 87 basis points lower compared to the historical baseline rate. People have voted en masse for Trump, and economic reasons might very well still have played a part in that, despite the very resilient US economy. If you look at headline GDP numbers, third quarter GDP 2.8%. But beneath the surface, high inflation and also employment growth decelerating might still have hurt the Kamala Harris votes.
I want to get more into US policy and outlook and the potential consequences. But first of all, Peter, and I know this is the area in the publication where you have responsibility for, was the very scenario. So what is your base case scenario for 2025?
Base case is that we are peak misery, or past peak misery.
Past peak,
yes.
okay.
Well past peak misery, I would say. So if you define misery as the sum of unemployment and inflation, then in Europe it already peaked late 2022. As I said earlier, we have seen so far only a sluggish recovery in Europe. But if you look at the historical patterns, so 6 quarters onwards from peak misery, typically things start to accelerate. So that does bode better for a reinvigorated European consumer, for instance. So in the base case, we do think that US will grow slightly below trend, 1.7%. That's 20 basis points below consensus, whereas inflation will average around 2.7%, which is also above consensus.
Okay. Yeah.
So we have a bit of a stagflationary twist relative to consensus expectations when it comes to growth and inflation forecast. But overall, 1.7% is still fairly decent, of course.
And your confidence on this scenario, because I know you always have a bear and a bull case as well.
So 55% for the baseline view, 25% for the bull case, and 20% for the bear case.
Okay, so slightly more upbeat on the outlook.
Well, if you make a probability-weighted scenario estimate, then it's more than slightly upbeat.
Okay.
So if you add bull and base case, then the future looks pretty bright.
Okay, so that's the picture. That's your analysis. I want to say gut feel, but no gut feel here. So proper analysis, a rigorous analysis that you've done. So going back to the prospect of change in the US and US policy, Colin, so economic policy, any sort of political policy that will have geopolitical ramifications, how do you think the Trump policy agenda can affect, let's start with the US economy?
So the US economy, so as Peter says, GDP growth of 4.5% nominal GDP next year, absolutely fine. So you put another couple of percent on top of that for corporates, so earnings growth of 6.5–7%. Seems fine. Seems fine to me, and we'll support the valuations that we have. It won't necessarily push them higher, but in terms of supporting the valuations, then we see that. Then because of the Republican sweep, then we can be more certain about the policies they're going to put in place. There's going to be very little pushback or very little ability of the Democrats to stop the agenda. So therefore, things like deregulation, things like tax cuts, these will come. They'll have to pay the piper later on, but as of today, these are upside surprises that could come into the US economy and therefore into earnings.
A bit more on that, Peter. So Colin referred to tax policy, tariff policy. What about clean energy spending? How do you think that could change, and what would be the consequences?
Well, I don't have very strong views about that. But at first glance, given the electoral mandate that has been given to Trump, I would think that it will experience some headwinds into 2025.
I think that's right. Because, again, Trump's energy policy is to drill, baby, drill.
Yes.
However, if you look at a per capita basis, then there's a lot of red states out there that have benefited from the IRA. So from that perspective, then Trump is very sensitive to his voters. So you could see him being less forceful in that, knowing that he's basically cutting subsidies to his voters.
there's so much more still unfolding. It's early days. We're seeing Trump's new cabinet gradually, almost day by day, the new announcements, for example, with RFK Jr.'s appointment on healthcare. We don't yet know what that might mean for healthcare spending, for example. But all of this will affect the rest of the world as well. Any views from either of you on what that could mean in terms of growth and therefore for asset selection?
Let me start here, and I think the US exceptionalism and isolationism means that less of the US growth leaks out to the rest of the globe and the rest of the economy. So, those countries that have self-starting economies, such as India, will fare better than necessarily those that rely on global trade, act as middlemen, or indeed manufacturing, or the manufacturing base of the global economy, like China and Southeast Asia. So from that perspective, the isolationism is going to restrict the growth in the rest of the world unless they can come up with policies that kickstart their economies.
Yeah, I think that's a very good point, because in under a Trump presidency, U.S. exceptionalism could even be self-reinforcing. Because given his protectionism, you have fewer technology spillovers, which are really the driver of productivity growth catch-up of, for instance, emerging markets versus the US, at least if you look at the historical track record. Yeah, and that process, productivity growth catch-up, thanks to technology spillovers, that's slowing or even disappearing if Trump really pursues his trade agenda. So I think also we will see a world that's becoming even more susceptible to negative supply side shocks under a Trump presidency. And that should also perhaps be priced in risk premia at some point when it really becomes apparent that he's really willing to pursue 60% tariffs on China, raising also the risk of retaliation. And if you look back at, for instance, the Smoot-Hawley Tariffs Act of 1930s, in the subsequent 4 years, global trade declined by 65%. And that's something that could happen again. Yeah. I think it deserves a small probability, but it is entirely plausible.
Listening to you talk about the possibility of reduced tech and innovation spillovers, it reminds me of your 5-year outlook, where in your bull case scenario you have AI fully driving productivity growth. So is that potentially under threat then?
Well, we have given 25% probability to the bull case. So the deregulation wave that Trump envisaged could even spur domestic AI adoption, and therefore, again, reinforce US exceptionalism. Yeah. As it is only the US that really pushes the technological frontier in this respect. But there's also indeed a possibility that it even backfires to the US.
So how would you go about your asset selection then, Colin? Let's start with the currencies, because you spoke about the dollar being stronger for longer. How does this environment of US exceptionalism influence the dollar then? Well,
to us, it will mean that we have to have a very strong case for why other currencies would appreciate against the dollar. We know how cheap the yen is, and that could continue for some time. So we just have to have that. And when the risk premium is so big, then there are chances that you have during the year where you get volatility and you get massive spikes in outperformance. We have seen it in the dollar this year. We saw it in Chinese equities. We've seen it in the bond market as well. So all these environments are going to happen throughout the year. And what we have to do is navigate them. And when things become so extreme, or everybody's on one side of the view, that's the time that we will be looking to take the other side.
Then within equities, Colin, where are you looking and what would you be avoiding?
Looking at the US.
Straightforward.
And period of exceptionalism, earnings supporting those valuations. But you have to be careful, because as we saw in August and September, these rotations can be brutal, and you can lose like a whole year's performance in the space of a few days. And so that's what we have to be in when we put our views together. We're not putting all of our clients' money on one view. We're saying, look, we need to spread them out because we don't know.
Are you willing to comment on your sector preferences, or is it still too early to say how these things might unfold? Clean energy, healthcare, etc.
So from that perspective, I think financials have had a very good year in terms of earnings, and that's been both in Europe and in the US. And that's telling you that actually the underlying economy is okay. So if financials are not rising, their non-performing loans, their bad debts, then that's telling you generally the economy's okay. It's not maybe expanding rapidly, but it's telling you it's fine. Mm-hmm. It's on a firm footing. If we go to Europe, then we definitely think about areas and sectors where you have pricing power over the US, or they need those particular airplanes or whatever it might be, or indeed where you've got intellectual property from Europe that's required in the US, and healthcare is an obvious example there.
Yeah, and given our upbeat view about reinvigorating European consumer, you could also see some strengthening in European cyclicals, for instance. And also in a world that still sees a bit of a fractured landscape when it comes to trade, there's more need for dual sourcing. And that could also be well for some REITs, for instance, for warehouse building, etc.
Right.
To feed the rising demand for dual sourcing. To address that, sorry.
Yeah, and the other surprise could be around China, because at the moment, if you read all the reports, the investor outlooks, China's very, very unloved.
Yes.
Yeah, people don't talk about it very much. And so, that's the sort of wild card for us. And that, again, is another reason why Europe might do better than the US. If you do see some further stimulus, something to get the domestic consumer off its knees and out there spending with activity in the Chinese economy.
Yeah, one of the signposts we are looking for in that respect is a more targeted fiscal stimulus of Chinese policymakers to reinvigorate the Chinese consumer, and that could happen entirely to offset a more imminent trade tariff threat from Trump. So that's really something, a signpost we are closely watching.
And EM more broadly, your 5-year outlook is very optimistic on emerging markets. So on a 1-year basis, less so, it sounds.
I think it's to do with the dollar. Over 5 years, you could definitely make the case of the dollar being a lot lower. Over a 1-year horizon, the case is more difficult to make.
Turning to fixed income, general remarks there, emerging market debt then, and then also on the credit side. What's the outlook?
Well, if you look at where spreads are for both IG and high yield, they are in the lowest decile relative to their overall history.
So looking expensive.
But they can stay expensive for longer.
Yes.
In a world that still sees in the US, for instance, close to trend growth. But they are expensive, so our fair value models show that the global high yield spread should be 150, 160 basis points higher than actual levels.
Okay.
So there's potential for them to widen, but I think if our base case materializes, the probability that they really widen more than 100 basis points, I think is still fairly limited.
Yeah, and you hear fixed income investors talking about the total return from credit and high yield. And to me, as a multi-asset investor, allows us actually flexibility here, because we can say, well, a lot of that return is going to come from your government bond or your sovereign bond. So put that at one end of your risk spectrum, but take your risk in something that has got upside. And that to us is in equities. So in our portfolios at the moment, we want to be underweight the credit piece, the spread piece, but overweight the equity piece, but have that safe haven of the government bonds in the portfolio as well.
And that's also consistent with what we have been observing most often in history. In soft landings, equities outperform the other risky assets. Mm.
So is that a neutral positioning, Colin, in government bonds?
We've actually been increasing it. The recent sell-off has allowed us to start going long duration. in Europe and in the US. We're still short duration in Japan because we think rates are still got to go up there. But in the sort of Western developed markets, we're really focusing on when we should be buying that. And if there's a spike higher because of the various announcements, then that's an opportunity for us. Eventually yields have to be higher if the fiscal largesse carries on, not just in the US but also in Europe as well. Then that does put government finances under pressure later on, and they should have to pay a higher yield or higher cost to borrow that money.
Indeed. So final remarks. I think momentum was a key factor in 2024. Do you expect that to continue? And then on your positioning, what I heard from what you said, Colin, is one needs to be highly tactical. You spoke about the significant swings in markets and how you can lose a year's performance. So just general final remarks on those 2 points.
Yeah, the momentum call, that's a difficult one, whether it can continue. Momentum has been the factor that has been outperforming for the last couple of years. So it's not a 2024 phenomenon. However, I think that if you look at the potential for a broadening out of growth across sectors, a catch-up of Europe and the UK versus US growth levels, I think that broadening out would be more consistent also with an improvement in value performance and value-related stocks relative to the momentum outperformance. So I think it would be wise to have a more diversified factor strategy or factor exposure and overall be very nimble. Momentum crashes are hard to prevent, but just blindly following momentum, I think would not be wise in 2025.
Great insights. Colin?
I think Peter summed up very nicely there. Where we'd also be looking at is also looking at the amount of money in the system, so what we would call liquidity. So we've seen rates start to come down, which increases the amount of money in the system, and that's what's found its way, and that's why equities have gone up, gold's gone up, Bitcoin's gone up, everything's gone up, because there is too much money chasing too few assets. So if you start to see liquidity drain, higher non-performing loans, those bad debts coming to the fore, then that's when you become more worried about your risk positions in your portfolios, your equities in your portfolios. So that's another signal for what we're watching. Being nimble, absolutely. Active management is the way forward.
That's it. Colin and Peter, thank you very much. Wonderful listening to you. And to listeners, thanks for being here. We publish a new episode every month covering a range of investment-related topics. This podcast and Robeco's Markets podcast, In Tune with the Markets, are available on all major podcast platforms and on the Robeco website. If you subscribe, you'll receive a notification as soon as the new episode is published. In the meantime, please rate the show and share the show link with a friend. Until next time.
Thanks for joining this Robeco podcast. Please tune in next time as well. Important information. This publication is intended for professional investors. The podcast was brought to you by Robeco and in the US by Robeco Institutional Asset Management US Inc., a Delaware corporation, as well as an investment advisor registered with the US Securities and Exchange Commission. Robeco Institutional Asset Management US is a wholly owned subsidiary of Oryx Corporation Europe NV, a Dutch investment management firm located in Rotterdam, the Netherlands. Robeco Institutional Asset Management BV has a license as manager of UCITS and AIFs for the Netherlands Authority for the Financial Markets in Amsterdam.